Okay, we have 2 cartons of milk here. One that expires in 2 days right here. 2 days. And this one expires in 2 weeks. All things being constant, which one would you choose? The 2 days or the 2 weeks? They're from the same supermarket, same price, same location, same temperature fluctuations. In fact, they're just right next to each other on the shelves. Which one would you pick? Welcome back, mindful investors. In this video, I'm going to talk about 3 things regarding expiration dates. Number 1, how the expiration dates affects the option premiums. Number 2, not all expiration dates are treated equal. Like, we can't just randomly pick a date. Every decision serves a purpose. And number 3, why some companies have options that expires every week. Some are every month, some are every quarter. Why is that? Getting back to the concept at the beginning of the video, which one would you choose, the 2-day milk or the 2-week milk? Well, the obvious answer, with all things being equal, you would choose the 2-week milk. That's probably because you only need to finish 1 liter of milk per week, which is 4 cups per week. It's very manageable. But for this side, the 2-day expiration, you have to finish 4 cups a day. And that's not very manageable. Most likely, it'll go bad before you finish it, right? Another reason is the margin of error. This 2-week carton may only last 1 week because of a number of factors like the temperature change, like the logistics and whatnot. If we look at the 2-day carton, if we minus the 7-day discrepancy, it's already expired. So buying this 2-day carton is extremely risky. All of this can be applied to the options game as well. Generally, an options contract that expires in 2 days is much cheaper than something that expires in 2 weeks and 2 months and 2 years, so forth. So there is a relationship. The longer the term, the more expensive the premiums are. Now we'll move on to a second point. Not all expiration dates are treated the same. For example, if we look at Tesla, we'll pick January 15th. We'll look at the strike for $800. Right now, the average price is about $5. Okay, let's mark this down. Tesla, 800, Jan 15th, $5. Now we'll compare it with the January 22nd, 29th, and so forth. This is the 22nd, is worth around $9 right here, $9. So Jan 22nd is about $9. Just bear with me here, there is a point I'm trying to prove. Even before looking at it, what is your predicted price for this contract? For the January 29th, what is your predicted price? Will it be $13? Yeah, that's reasonable, right? Because you have $5 for Jan 15th, $9 for Jan 22nd. So we just extrapolate for this linear line that says Jan 29th would cost $13. That's reasonable. But let's take a look. January 29th, $14. So that's slightly higher than what we estimated, but there is a reason for that. I'll tell you what the main reason is here, is the implied volatility. Right here, we see that the implied volatility for $800 is at 65%. But if we go back to the previous one, let's say to the January 15th, January 15th, $800 is about 60% implied volatility. Between 60% and 66%, that's a 10% discrepancy. So there are a lot more implied volatility for this January 29th. Why is that? Well, January 29th in itself is pretty special. Because right here, if we look at Tesla, we scroll down, they say that the earnings date is January 27th to February 1st. So January 29th is in the middle of this earnings week. Right now, they haven't really pinpointed that certain date, but we know an earnings report will come within these couple of days. So that's when people expect the larger swings. Normally after an earnings report for a volatile stock like this, the stock price can easily swing 10+% in a matter of 2-3 days. And that's why not all expiration dates are treated equal. This concept doesn't only apply for earnings dates, it applies for certain events as well. Let's take a quick look at another example, NIO. NIO has its NIO day on January 9th, right here. So we expect the stock to swing a little bit more during the week of January 9th. Let's take a quick look. And then we'll look at the options chain right here. Something a little bit farther away, let's say $50. For this week that ends in a couple days, the $50 is at 81% implied volatility. But for the next week, January 8th, which is the week of the Neo Day, there should be a run up. People should expect implied volatility to go up. We'll take a look. It's at 100%. And what did we have before? We had 80%. So from 80 to 100 is 25% more. So people for that week are expecting the stock to swing 25% more than the previous week. When you pick an expiration date, pay attention to these special events. Whether it was Neo Day, where they release all the new tech, or the earnings date, where they report the previous quarter's numbers, or the ex-dividend dates. Because for the dividend investors who are holding these stocks, after this ex-dividend date, they can just sell it off. They can just sell off the stocks, but still collect the dividends. So there may be a fluctuation there as well. Another date to pay attention to is the third Friday of every month. That's when a lot of option contracts expire, and we can expect some fluctuations due to people shorting or getting short squeezed. On to the third point, the frequency for option expirations are different between various companies. If we look at Tesla right here, they have options that expire every single week. But conversely, if we look at something like an Enbridge, a blue chipper and old school energy stock, for the year of 2021, it only shows 4 different dates. So why is that? Let's use the casino table analogies. If we're the operator of a casino, we would want to put games out that people want to play, right? And also, we would want to do it in a manner that saves space but maximizes the profits. Therefore, in most casinos, you see a whole bunch of slot machines. Because these machines don't need to be managed, they take up a little bit of floor space, and you can just program as percentage payout. Therefore, these machines just pay for themselves. Moving back to the options game, we would want to only open tables that people are willing to play at. And we would definitely open more tables for the hype stocks like Tesla, that swings 10%, 20% per month easy. The more action there is, the more money they make. So that's why stocks like Enbridge, which doesn't move much, would have much lesser tables to play at. Drop a like and subscribe to the channel if you found any value in the video. Thanks for watching, take care, and I'll see you in the next one.